to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth. I am your host, Mallory Meehan, aka Prof M, and I am joined with me by Matt Linville. Matt, how are you today?
Mallory, I am doing fantastic, and I'm even better now that I have a chance to sit down and talk with you on a what I think both of us could say might be a hectic Tuesday. But this is the fun part of the day, getting to sit down and talk about the details of tax and 1031s.
Love it. Yes. So how about we start off, Matt? You tell us a little bit about your background and a little bit about yourself and kind of maybe how you got into the tax world.
Yeah, I'd be glad to. So first off, for all those wondering where I might be sitting today, I'm sitting in the big town of Pilot Mountain in North Carolina. And though that may not seem familiar right off the bat, Mallory, most people might recognize it as Mount Pilot from the Andy Griffith Show. And that's kind of our claim to fame. And I'll just throw in a little plug for my wife, Abigail. She's actually the director of the Andy Griffith Museum in Mount Airy. So if for all the folks who are traveling from the Northeast to Ohio and Wisconsin who are coming down this way, so many stop by Mount Airy and they're attracted from, knowing and loving the Andy Griffith Show. So that's kind of where we sit. So even a better question of Matt, how do you get involved in 1031 like kind of exchanges in what most people might consider a small town? And I would say that it started, Mallory, when I began my career at Wachovia Bank in downtown Winston-Salem. I came in financial planning and personal trust. And it wasn't but a couple of years earlier that the bank had started their own qualified intermediary. I happened to know somebody who worked in that department, and they said, Matt, I think you need to come over here and learn about this. You may like this. And boy, were they ever right. So for over 20 years, Mallory, 1031s, they are a passion point professionally for me. I absolutely love what they do, who they help, how they help them, and what it enables families and companies, corporations from big to small do, what it helps them accomplish in the real estate investment world.
Awesome. I love that. So I guess before we dive too much into talking about 1031s, how about you give our listeners an overview as to what 1031 means, what can it do, and just kind of give us how if we're investors, how we can use it.
Yeah. So believe it or not, for over 100 years, 1031s have been a part of our tax code. Now, over the years, there have been several different iterations of this particular code. But what we have today, Mallory, is the IRS telling us that if you are a taxpayer who owns real property, and that real property has been held for business or investment use, when you sell that piece of property through the 1031 like-kind exchange, the IRS will not immediately make you or allow you to actually defer, not exempt, but defer the tax that you would normally pay on the gain from the sale of that piece of property. Now, that's two great things. I'm getting to sell real estate that I've held for investment or business use. I'm getting to defer the tax I would normally pay. And on the backside, what the IRS says is we want you to roll those monies into other real property that, again, you would hold for business or investment use. And that would complete the 1031 transaction. And again, would allow you to defer all the tax that you would normally pay and basically reinvest that going forward into another property or properties for that real estate investor. So again, for over 100 years, this is a well-vetted, court-tested, allowable, by the code, by the IRS. And so one of the things that we may hear is that the 1031 is a tax loophole. There are very few things in life that make the hair on the back of my neck stand up. And that's one of them is it's not a tax loophole. We're not getting away with anything. We're actually doing exactly what the IRS allows us to do as taxpayers. And I think it's absolutely thrilling because, Mallory, you know the folks that we're dealing with. These are not always super wealthy families. These are families who are selling one-off rental homes, maybe land that they have inherited, smaller commercial buildings, and they may well manage it. And so they're at the dining room table every night, worried about who's going to go to court the next day, who's going to be there at the property to look over, somebody coming in and making improvements to the property, who's going to go over there and plunge the toilet at 2 o'clock in the morning when that needs to be done. So the idea that all of this sweat equity, blood, sweat, and tears that they're putting into this property, and the ability to then save all of that equity that they've built and potentially roll that over into other property that's more hands-off or maybe providing income for them and they're in their later retirement years. The 1031 is just a strategic part, can be a strategic part of an investment portfolio for families.
No, that's great. And I think you gave us a really good idea of what, 1031, it's a section in the IRS code. And can you give us a little bit of detail? If I own a property, what does like-kind exchange mean? Are there restrictions with a 1031? And what would I need to do before I sell?
Gotcha. So, and that's a wonderful question because we'll go ahead and be able to knock out one of the most common misconceptions about the 1031 like-kind exchange. So even by its title, it would seem to be very defining and restrictive, but actually it's not. So if we go back to that definition, it is any real property for any other real property. So the call that I might get from a client is, okay, Matt, we're selling a single family rental. And I know because it's a like-kind exchange, we have to buy another single family rental. And they certainly can, but it's so much more broad than that. So I could sell my single family residential property and I could go out and buy a car wash. I could sell a car wash and go buy a bank property. I could sell a bank property, go buy multifamily. I could sell multifamily, go buy land. So again, as long as it's classified as real property and it's going to be held for the right use, the asset classes are not restrictive. It could be anything for anything, even within the 50 states. So I could sell in New York and buy in California, sell in California, buy in Florida. Even that locale does not matter when it comes to the 1031 like-kind exchange.
Awesome. I love that. So let's say I had inherited a property and it's a single family home. We'll stick with that. And I'm now looking to sell. I know that because I inherited, I may have a step up basis or, appreciated gains over that course of ownership. And if I sell, I'm going to be subject to some tax liability, hopefully in long-term tax capital.
Right. Yeah, hopefully.
But if I want to defer that, what processes do I need to follow in order to satisfy the 1031 exchange rules?
So I would always suggest first step, talk with your tax advisor, number one, for exactly the reason that you outlined. I inherited that piece of property. I inherited it with a step up in basis to the fair market value of the date of death of the one from which I inherited the property. And I need to know what the basis is in that piece of property so I could then know what my tax bite may be. And I think that's such a very, very important starting place because, Mallory, you and I are different. And one amount of tax may be something that you look at and go, I'm willing just to pay that and just go ahead and go my way. Whereas I might look at it and go, there's no way in the world I'm paying that. I'm definitely going to do this exchange. So everybody's a little bit different. So definitely step one, CPA count it. Let's talk about what that tax hit may be if you look at selling. After that conversation, if a 1031 is a possibility, then number two, we need to look at what are their where do they want to be with that money? Since we know they have to buy at least one property after they sell, where are they looking? What do they want to buy? Income producing? Are they more concerned about income or appreciation? So that's where we have our great agents and brokers come in and be able to talk to them about kind of their investment plan. Now, you notice both of those steps have nothing to do with me whatsoever. But those are two things that everybody really needs to take as step 1 and 2 when they're considering a 1031. Third, certainly call your qualified intermediary and let's talk about several different facets of your ownership. How do you own it? How long have you owned it? Since you mentioned it would be a single family rental, there's really 3 questions that I'm going to ask them. And it has to do with one of the safe harbors the IRS provided us for residential investment property in 1031. So Mallory, if you were to ask me, okay, Matt, I've owned this property for X amount of time, how long am I supposed to own a piece of property before it will qualify for a 1031? And what I can tell you is the IRS did not say. They gave us no time frame whatsoever. What they did say was, from day one, your intent needed to be to hold it for business or investment use. Now, fortunately, with residential investment real estate, back in 2008, it's actually 2008-16, the IRS gave us the safe harbor for residential investment property. And there's 3 markers that the IRS said, if you meet these 3 things, then we're not going to ask you any questions about your 1031, how long that property was owned, or your use. So 3 things. You must have owned the property for at least 24 months before you sell it in the 1031. Okay, so that's number 1. You could have owned it for 10 years. That's great, but minimum 24 months. So let's look at those that 24-month period, and let's break those out into 2 12-month periods. So in each 12-month period out of that 24 months, number 2, you must have rented that property for a minimum of 14 days at fair market rent. Okay, you could have rented it 300, but the IRS says the minimum is 14 days per 12-month period at fair market rent. Lastly, number 3, we have the limitation on personal use. And so the IRS says you need to limit your personal use of that property to either 14 days or 10% of the time in which the property was rented, whichever one is greater. So if they rented it for 14 days, then the IRS is going to limit their personal use each 12 months to 14 days. Or if they rented it for the 300 days, then they'd have 30 days of personal use. So that's what we really want to talk about with that client when they're considering a 1031. Again, CPA account it, go ahead and start talking to your real estate advisor. Third, go ahead and get on the phone with a qualified intermediary to start talking about these very important things. But most important is after they've signed their contract, okay, we have a contract in place to sell. They must have an exchange agreement signed and dated, entered into with a qualified intermediary before they close on the sale of their property. If they close and there's no exchange agreement, they have no 1031. It doesn't matter how much we talked about or how much they really wanted to do it. Right. If they close without an exchange agreement in place, and they have the right, or they actually receive the money from closing, then that is constructive receipt, and everything that we'll do before that sale, being the exchange agreement, being in place, the whole thing is to avoid constructive receipt. Taxpayer cannot touch that money. So out of everything, step 1, 2, and 3, once those are done, the most important thing is to make sure they have an agreement in place with a qualified intermediary so that 1031 is actual and factual.
Perfect explanation. I don't think I could have explained it better. I do want to take a step back though, and can you describe to us exactly what a qualified intermediary is and how we would go about finding one?
Absolutely. So the qualified intermediary became that necessary third party to a 1031 like-kind exchange transaction. For years, the only type of 1031 that was allowed is, Mallory, if you had a piece of property I wanted, I had a piece of property you wanted, and we basically swapped deeds, and maybe one of us got boot, whoever it might be. But that was the 1031. There was no other party. I wouldn't sell to you and then go buy my replacement property from someone else. So once that kind of third leg of this transaction kicked in, the IRS said, listen, we need a party who can hold these funds and be independent of the taxpayer. And so I would say that if I could dispel kind of misnomer number two we're kind of talking about is when we talk about qualified intermediary, the only thing that makes us qualified is that we're not one of two things. We are not an agent of the taxpayer or haven't been in the past 2 years, meaning I'm not an attorney or CPA who did work for that taxpayer. I'm not their real estate agent or broker. And number two, I'm not a related party to the taxpayer. Those are the only two things that make someone a qualified intermediary. So literally we could stop the podcast, okay? You could go outside and stop the next car that drives by and say, hey, I don't know you. You're not related to me. You haven't done any work for me in the past 2 years. Would you like to hold $1 million for me for 1031? So even though the definition might be quite broad, the qualified intermediary or QI that they may choose to work with, you need to make sure they're trustworthy. I mean, they're holding your money. They're responsible for creating the exchange agreement that should meet all the IRS qualifications. They're going to be responsible for working with the attorney or the closing agent or title company in making sure all the documents and closing statements are correct. They'll be receiving the money directly from the escrow or from the attorney's escrow account, wired directly to that QI that they choose. That QI is responsible for keeping the money safe. And also, when it's time to buy that next property, the QI will do everything in reverse, working with that closing attorney or escrow office, making sure that funds are wired there, closing statements are correct, everything's handled. So that QI needs to be experienced. They need to have insurance. I want to know, do they have attorneys on staff? How many are you? Where are you located? Who are you banking with? What type of account are you holding my money in? Is it a bankruptcy remote account, or is it considered company funds? Do you have certified exchange specialists on staff, people who know what they're doing and what they're talking about? So the QI is so very important. Now you ask how they might be able to find a QI. So our kind of trade organization is the Federation of Exchange Accommodators, or FEA. And you can go to www.1031.org and go to that site, and those qualified intermediaries that are members will be listed for everybody to kind of see and choose if they want someone close to them, if they want somebody nationally, or you could simply look up qualified intermediary on the internet. We're everywhere. But it's really important to, certainly if you're working with an attorney or a title company, ask them who they've used in the past. Who are they comfortable with? Who have they worked well with? How has that communication been back and forth? Look for recommendations like you would your real estate agent, or you're out looking for a CPA or a banker, a commercial lender. Those are the same type questions you would need to ask for the qualified intermediary.
Love it. Love it. Okay. So I want to talk more about, we're going to go back to our example. I have a single family home and I'm looking to sell. I inherited it and I like real estate. I maybe want some more cash flow. I have some value now added up. What is my next step that I have to follow in order to qualify for this 1031 exchange?
Okay. So once you've picked your QI, once you have an exchange agreement in place, once you've closed on that piece of property, and we've basically had the net proceeds from the sale of that property of yours go to the qualified intermediary, that day of closing is going to, two clocks are going to begin to tick. And these two clocks are of the utmost importance to the client. And so there is one clock, which is our 45-day identification period. And the second clock is our 180-day exchange period. And again, both of those are going to begin to tick on the very same day. So if I am a client who is about to sell and do a 1031, or I have just sold, what the IRS is saying is that you have 45 days to find and identify potential replacement property for your 1031 like-kind exchange. Now, those 45 days are straight calendar days. So Saturdays, Sundays, rainy days and Mondays, vacation days, kids are sick days, I just don't feel like it days. All of those count in that 45-day calculation. So when we're waiting on a check, okay, 45 days can seem like a really long time. When you're trying to find property that you're comfortable with buying in your 1031, 45 days can go by so very fast. So that's step number one. Let's go back to talking with that real estate advisor. And maybe even before you sell, you're already kind of out looking at properties. You're already talking about markets and asset classes. So you can begin to develop an idea of where you want to be and how you want to be placed there. Because again, that 45 days is so very quick. But let's give an example. So let's say on day 3, Mallory, you go out and you find the most wonderful duplex that's going to provide you some great income and appreciation in a great area with very little involvement from, fixing it upside. And on day 2, you write it out. Okay, Matt, I'm buying duplex 12 on 100 Main Street in Wilmington, North Carolina. And I'm buying that. And on day 20, you find out, well, it's no longer available. For the million reasons that it can fall off the market, it's fallen off. Well, you're still within your 45-day period. So you can amend your identification, strike that property, and we're going to go out and find some other property. So during that 45 days, that identification is fluid. But on midnight of day 45, whatever is identified to the qualified intermediary, you might as well chisel it in stone. You'll have to buy at least one of the properties that you identified to get any benefit from the 1031 like-kind exchange. So that's time frame number 1. Time frame number 2 is the IRS says you have either 180 days or until your tax filing due date, whichever one is less, to actually close and take title to any or all of the property that the taxpayer has identified. So you might have people who say, well, you have 6 months. Well, it's technically not right. You have 180 days. That's not necessarily 6 months. So you have 180 days or until your tax filing due date. So here's the interesting part, Mallory. When we look at this time of year, people start to list properties and maybe it doesn't close until the 1st of December. And they own it personally, so they don't have to file until April for 2024. But if they sell in December, do a 1031, since they have to report the sale of the property in 24, and since they must complete their 1031 so that they can report it on their 24 taxes, then they need to complete that 1031 before April 15th. But that's not 180 days. So they actually have less time. Now, is there a workaround? Certainly, they could file for an extension, back that date up until October, and then they could have their full 180 days. But again, these are the things that are important to talk about with the qualified intermediary. Your partnership and your filing in March, you need to know that you might be cut short, or if you're owned it personally and you're filing in April, or if you've chosen some other filing tax date, it's important to know when that is to make sure that you're able to take effect of your full 180 days.
Yeah, no, that's great advice. So let's say that I'm going out and I want to be safe. I want to make sure that whatever property I identified isn't going to be off the market. Am I limited by the number of properties that I can kind of outline, or am I also limited to the number of properties I can buy from the proceeds of my sale?
So yes and no. So let's look at the rules for identification, and there are 3 rules for that 45-day identification period when it comes to how many or how much. So the majority of the time, taxpayers will use the 3 property rule. And what the IRS said is, we're fine if you identify 1, 2, or 3 properties. And for identification purposes, we don't care what the fair market values of those 1, 2, or 3 properties happen to be. So let me back up just for a second to make sure this isn't confusing, okay? So if the question posed to me is, Matt, I'm selling a piece of property for $1 million. I want to do a 1031, and I don't want to pay any tax. How much of that money do I have to use in my 1031 to get my full tax deferral? And the IRS made it very easy. They said, if you're selling for $1 million, then what we want to see is for you to buy another property or properties that equal at least $1 million. Okay. And that way you're guaranteed to have a full tax deferral defer everything. So when I say that the IRS for identification purposes doesn't care about the amounts for properties 1, 2, or 3, it's only for identification. So let's go back. I've sold for $1 million. That single family rental that I inherited was a nice property, $1 million. And now I can identify 1, 2, or 3 properties, and the 3 combined could be worth $40 million. The IRS doesn't care. Okay. Now the taxpayer may care, the lender may care, but the IRS doesn't care for identification. So again, we call it the 3 free, 1, 2, or 3. And that's helpful because let's say that, let's say I identify property number 1. And that's the property I have. I mean, my heart's set on property number 1. And I go past day 45. And on day 60, I find out I can't buy the property. Well, if that was the only property that I identified, and now I'm past my 45 days, the IRS doesn't care that you couldn't close on it, or you were able to go in and inspect it and you found all kinds of problems that you don't want to deal with. The IRS doesn't care. I mean, they don't have a heart for that. So the 3 property rule really helps to say, I'm dead set on property A. But in case I can't close on property A, let's look at property B and property C as backups. Or, gosh, Mallory, you sold that thing for $1 million. Could you take $333,000 and put that down on 3 different properties and use the power of leverage? And now you've sold $1 million property, and now you own a portfolio of 3 different properties well north of $1 million? Absolutely. And that 3 property rule can be extremely helpful. Okay. Now, what if the client says, well, Matt, I want to identify 20 properties. Can I? It's possible, but now it's a numbers game. So now we have the 200% rule. So anytime you hit property number 4 or above, then the IRS is going to weigh the fair market value of all the properties that you're identifying. So let's go back. I sold for $1 million. I want to identify 10 properties. That's fine, as long as that combined fair market value of those 10 properties are not more than 200% of the price of the property that I sold. So I can identify 10 as long as they're not worth more than $2 million from the fair market value sense. So there is an ability to identify an unlimited number of properties, but the numbers have to work.
Yeah. No,
So that is something I'm definitely concerned about, and we're going to talk to about my real estate advisor as well.
yeah, and I guess so for a 1031 to occur, do I have to invest everything? Can I invest part of it and still not have to pay tax on part of it, or how does that piece work?
Absolutely. Wonderfully, it's not an all or nothing deal. So yes, if we have a client who says, you know, Matt, we're selling for the million, we're going to walk away with 150,000 because we want to go do X with it. And that's perfectly fine. Walk away with whatever money that you want to keep, allow the rest of it to go to the qualified intermediary, and you can look at a potential partial deferral. Now, I would always suggest anytime anybody wants to hold back money, if they haven't already, talk to their tax advisor and just make sure that they're not pulling too much money out. You know, they're not taking all, you know, the full gain. They're basically walking away with that, and they might experience no benefit from the 1031. I think that would be horrible. So go back and talk to their advisor, make sure. And here's the second thing that I would talk about as well. What would be the possibility, instead of walking away with $150,000 and being taxed on it potentially, what would be the possibility of putting 100% of the funds into the exchange, go buy the next property at some point near or far, looking at a cash out refi, pulling some equity out tax free, and maybe that might be a better way to go than paying the tax they might have had to pay if they took it out and didn't roll it into the 1031. So again, something really great to talk to their tax advisor about to make sure they're taking the best steps forward.
Right. No, definitely great advice. Now, we're back into my example. I have the property that I sold for $1 million and I inherited it personally. Now, I've learned all about legal structures and entities, and I don't want to have my next property or properties owned in my personal name. I would rather create a business entity. Are there any restrictions with how I can take ownership, or if I wanted to go in with a partner, how could that work?
Certainly. And one very simple rule has the power of tripping up a lot of great and well-laid plans. And that very simple rule is called the same taxpayer rule. And what the IRS requires is that the entity that sells the property must be the entity that buys the property. And so in your example, if I'm selling it personally, then the IRS still wants me to buy that next property in my personal name. Now, however, there are existing abilities to, let's say, I could buy my next property, even though I sold it as Matt Linville, I could buy it in Linville LLC. As long as Linville LLC is a pass-through entity using my tax ID, taxed right back to me. But maybe that's a better ownership structure for that next property. Maybe I like to see that. Maybe the bank will want to see that. You know, whoever might be an interested party may want to see it that way. But that's a possibility, as long as it's a pass-through again back to me personally. When it comes to buying into, let's say, an existing partnership, and you know, you and some partners own some properties, you having a partnership, I'm selling my piece of property, and you say, Matt, listen, we'd love to have you come join us. With your amount of money, you could buy in 8% of our partnership. The IRS will actually not allow that, because partnership interests are seen as personal property and not real property. Even if that partnership only owns real estate, it's still a personal property interest into a partnership, and it would not qualify as a 1031. Now, however, if the two of us, you know, I sold my piece of property, you had some money, and we went out and found property B together, and you said, Matt, let's buy this thing together. Well, I'm in a 1031. I still have to buy it in my name or pass-through entity LLC. You have your money, you're bringing it in, that's fine. Let's go buy a tenant in common, okay? I own my 50% deeded interest. You own your 50% deeded interest. It's not a partnership. We don't tax it as a partnership. We don't report it that way. But that's how we may be able to come in together and buy something and still be mindful of that same taxpayer requirement from the 1031 side. But it's tricky, especially when, let's say there's a partnership, they own a piece of property, they're looking at selling, there's several different partners and everybody says we're done for good reasons or bad, we're just finished. I want my money and I want to move on. And somebody out of the group says, I want to sell mine and do a 1031. How can I do that? Those are situations that really require your CPA, a good tax attorney, and a great qualified intermediary of how do you take the partnership? Can you dissolve it? Can everybody go out tenants in common? Now you own your own separate deeded piece of that. And when you sell, that makes it very easy for each party to do whatever it is they wish. But there's really a question of when does that need to happen? How does that happen? Is there any existing debt where the lender's going to go, no, 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 don't, I'm not cool with this thing going away. Okay. So there's just so much to consider. And again, these are things that need to be talked about much sooner than later. And how do we make sure that everybody's taking the right step? And usually that comes from communication that happens soon and it happens fast and it happens accurately. And that way parties can decide what they need to do down the road.
That was my follow-up question, is if we had multiple people owning it, how do we take our share out? And that's a great explanation and something I actually didn't think about. So I learned something today too. Yeah. So I guess one of the last things I want to kind of get your thoughts on, obviously we're in an election year right now, and I think there are different thoughts on different aspects. What do you think might change or could occur when it comes specifically to 1031 exchanges? Because I know there has been some talk over, are we going to eliminate it? Are we going to restrict it more? Or are we going to expand upon it? So I'd love to hear your take on that.
Great. Well, I'll tell you, it is, I have a personal care about what happens with 1031s. It's, something that I do and care that it continues in its current form. However, 1031s have been on the chopping block for years and years and years. And whether or not they actually make it to the block, it's a really good talking point for politicians. And I'm going to make some very agnostic statements about politics. Because let's look at both sides of the aisle. In 2018, with the Tax Cut Jobs Act, we almost lost 1031s altogether. However, after much debate, after much lobbying, only personal property was taken out of the 1031 like-kind exchange. So before, you could do an exchange on aircraft, on boats, on fleet vehicles, on herds of cattle. I mean, you could do all kinds of exchanges, and they were extremely specific. So they were by class. And so if I sold a herd of cattle, it mattered if I had bulls or heifers. I mean, it was very, very specific. And I could sell a truck and buy another truck. I couldn't sell a truck and buy a boat. So no matter, all of that went away in 2018. Now, what was replaced was we had accelerated depreciation. It kind of took its place, and pros and cons to all of it. But that was in what most would consider a very business investment friendly administration. We almost lost 1031s. So let's take it now to the past couple of terms with the Biden administration. 1031 limitations have been a part of Biden's Green Book for several of his budgets. And that was the attempt to now cap the amount of gains that could be deferred from a single filer or a joint filer, $500,000 to $1 million a year, capping the amount which they could have experienced a deferral. That has not made it into law. And a few months ago, I was on the Hill with a few of my fellow qualified intermediaries, meeting with representatives from Colorado, Tennessee, and North Carolina. All of those offices had a very good understanding of 1031s and how they worked and how they were extremely of great benefit to their districts. And people on both sides of the aisle, they use 1031s, and their families use 1031s. And maybe not necessarily everybody who would vote for them, but for people who give a large amount of money, they also do 1031. So what was kind of given to us from both sides of the aisle was, don't need to worry about it. It's going to be just fine. Now, most recently, in the Democratic platform document, the last paragraph of page 16 specifically notes that they will eliminate the 1031 like-kind exchange loophole for wealthy Americans. So that's kind of a pie in the sky document of here's all the things that we would like to do. Whether or not they are reality or may come close to being reality, we don't know. But certainly 1031s are again on the chopping block. So I always encourage, especially when I'm talking with brokers and agents, talk to your representatives, tell them how much 1031s help you and your business. Tell them how much 1031s help downtowns when you have sellers who are willing to sell, but they don't want to pay the tax, and you have people who are willing to deploy money through their 1031 to buy and improve and build up not just the buildings themselves, but also the corresponding tax bases or tax base that comes along with those properties. Am I biased, Mallory? Yes, very much so. I've seen the
I would hope you could be.
Yeah, I've seen it, help my own family, my own friends, and certainly all of our clients. So if you find it of benefit and of help, it's something worth fighting for and making a call or sending an email. We'll certainly keep everybody up to date through our social media and kind of what's going on. But just know it's on the block, and hopefully, as in the past years, it will not be touched and we'll continue on as we are.
That's great. So Matt, final thoughts. Give our listeners a piece of advice that you think they should take with them after listening to this podcast.
A 1031 like-kind exchange is not just a one-time fix-all for avoiding capital gains. I look at it as a much bigger plan. Mallory, if I'm able to sell a piece of property through a 1031, defer the tax that I would normally pay, have those monies to reinvest and to grow my real estate portfolio. And if our estate planning laws stay the same, and if our step up in basis stays in place, then throughout my lifetime, Mallory, I'm able to buy and sell through the 1031, defer the capital gains tax, my state tax if my state happens to have one, my net investment income tax if my income happens to allow me to pay that wonderful 3.8%. And the depreciation recapture that I would normally have to pay, all of that is deferred. I pass away, it goes through my estate, and all of that tax that I would normally had to have paid goes away. And again, my children inherit that piece of property or properties at a step up in basis. And so they do not inherit my tax burden. Mm-hmm. And all of a sudden, I am able to build something that hopefully I can be very proud of. And it can be of great benefit to my family, my immediate family. And then I can pass along properties that I know will benefit my children, and they're properties that I know would not be a burden to them when they inherit them, because I can make sure that I'm purchasing properties that may even be triple net, or maybe the Delaware Statutory Trust, DST type of properties where they're getting appreciation and income, and they have no physical hands-on management responsibilities for those properties. So that's how I would look at it. Look at it for your next sale. That's great. But how can that help you build that portfolio and pass along a something you're proud of to your family? That's how I look at it, and that's why I'm so passionate about it, because I've seen it firsthand, the power that a 1031 has.
Yep. So pass on that legacy to the next generation.
That's right.
Awesome. Matt, how can people get in touch with you if they're looking for a qualified intermediary, or if they're maybe looking for some answers on questions around 1031s?
Yeah, so they can reach me directly. My cell phone, which again, I answer Monday through Sunday, 984-484-8685. Email mlinville, Linville, at invtitle.com or www.invtitle.com. Anything in the world I can ever do for anybody, answering questions or walking through scenarios, doesn't cost a thing, but very glad to talk with them.
That's wonderful. Matt, thank you again for being on the show. And for our listeners, that's a wrap, and we are out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.